Hey everyone, welcome back to Corporate Decoder, the place where we try to read between the lines of corporate filings and see what is really going on behind the slick press releases. In today's episode, we're diving into a filing from Canadian Pacific Kansas City Limited, or CPKC, as you'll often hear them called. Prepare yourselves for some interesting news about dividends. Before we dive in, if you love getting these unfiltered takes on company financials, make sure you are subscribed. And if you want to chat more about these filings and get direct access to our analysis, join our Discord community. The link is in the description below. So Canadian Pacific Kansas City Limited, also known as CPKC, has just put out another report. This one is a Form 8K, which is essentially a filing that tells the public about any important events that happen outside of the regular reporting schedule. Think of it as a quick update when something significant occurs. The main reason for this filing on the 31st of October 2025 is to announce something pretty straightforward but important for shareholders. They are talking about their dividends. CPKC is a major player in freight transportation, especially known for its vast railway network across North America. They connect a lot of industries and move a massive amount of goods from coast to coast. This kind of business is foundational to the economy, but also subject to many factors like economic cycles and regulatory changes. Now, CPKC is a publicly traded company. This means its shares are bought and sold on stock exchanges. You can find their common shares on the New York Stock Exchange under the ticker symbol CP and also on the Toronto Stock Exchange. Also, as CP, they also have some debenture stock, which is basically a type of long. Term debt that trades on exchanges too. It is important to know where a company's stock is listed because it tells us it is accessible to public investors. The core of this particular filing, the other events section, is where the big news is. On the 29th of October 2025, the company's board of directors made a decision. They declared a quarterly dividend. Now, what is a dividend? Simply put, it is a way for a company to share its profits directly with its shareholders. When a company does well and makes more money than it needs to reinvest in its operations, it can choose to return some of that profit to the people who own its stock. Specifically, they announced a dividend of $0.228 for each share of common stock. This might not sound like a lot on a per-share basis, but when you own many shares, it adds up. For a company like CPKC that has millions of shares outstanding, this translates to a significant payout going back to investors. The payment date for this dividend is set for the 26th of January 2026, and if you want to receive this dividend, you needed to be a shareholder of record by the close of business on the 31st of December 2025. This is how they ensure the money goes to the current owners of the stock. The filing also includes their exhibits. This is where they attach supporting documents. In this case, Exhibit 99.1 is the press release from the 29th of October that details this dividend announcement. It is good practice for companies to provide an actual press release so that everyone has access to the same information in a clear format. And then there is Exhibit 104. Which is important for transparency in the digital age. It is the cover page interactive data file, which means the key information from this cover page is presented in a machine-readable format, making it easier for analysts and algorithms to process. Now let's look at this from a broader perspective. When a company like CPKC declares a dividend, it signals a few things. Firstly, it shows confidence from the management and the board. They believe the company is financially healthy enough not only to continue its operations and invest in its future, but also to return value to its shareholders. In the railroad industry, consistent dividend payments can be a sign of stable earnings and a mature business model. Railroads often have high fixed costs and stable demand for their services, which can lead to predictable cash flows. This specific dividend, though relatively small per S-hair, is part of a larger pattern. Many established companies, especially those in essential industries like transportation, aim to provide regular income to their investors through dividends. For long-term investors, these dividend payments can be a significant part of their overall return, providing a steady stream of income that can be reinvested or used for other purposes. However, we also need to consider the context. While dividends are great for shareholders, the decision to pay them also means that cash is not being immediately reinvested into the business for expansion, acquisitions, or debt reduction. For CPKC, a company that is constantly investing in its infrastructure, rolling stock, and strategic growth like its recent acquisition of Kansas City Southern, balancing dividend payments with capital expenditures is crucial. A company that pays out too much in dividends might be sacrificing its long-term growth potential. Conversely, a company that doesn't return any value to shareholders might see its stock price stagnate. Looking at CPKC's history, they have been in a period of significant transformation, integrating the Kansas City Southern Railway and expanding their reach. This 8K, while focused on a dividend, doesn't provide deep financial tables like a quarterly earnings report. But the decision to maintain or increase dividends during such a period of integration and expansion often shows a strong belief in the combined entity's profitability and cash-generating ability. It suggests that CPKC management feels confident that the synergies from the merger are materializing and contributing positively to the bottom line. So, what is our take on this? CPKC's decision to declare a quarterly dividend of $0.228 per share is precisely what you'd expect from a well-established mature company in a vital industry. It demonstrates financial stability and a commitment to shareholder returns. The key for investors is to watch how these dividend payments stack up against their investments in growth and infrastructure. If the company can effectively grow its earnings alongside its dividend payouts, it signals a healthy, sustainable business strategy. The integration of Kansas City Southern is a massive undertaking. And the fact they are maintaining these dividends suggests they are managing this integration effectively and are generating enough cash flow to support both operations and shareholder distributions. A potential risk, however, would be if these dividend payouts were to dip significantly in the future, which could be an early indicator of underlying financial stress or a shift in strategic priorities away from shareholder returns towards more aggressive reinvestment. Alright, that is our quick decode of this CPKC filing. What do you think about this dividend announcement and its implications for the company's future? Let us know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. And remember, join our Discord community for ongoing discussions. Thanks for watching, and we'll see you in the next Corporate Decoder.